Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 3. This is Section E4. This is an application topic. Perform appropriate audit procedures, including inquiring of management and others, reviewing minutes, and sending external confirmations to detect the existence of litigation, claims, and assessments. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it is free, it is only 1 hour long, and in that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time struggling with the exam. So make sure you check out the webinar. Also, after that, you're going to want to learn more, so make sure you check out becoming a pro member of SuperfastCPA. Pro members get access to the full 10-question versions of these videos. In today's video, we're only going to be going over 5 questions, but again, the pro members will get access to the full 10-question version of the video so that they can get a little bit more practice and a little bit more understanding. So make sure you check out becoming a pro member, and again, make sure you check out the webinar. With all that, let's dive straight into the questions. All right, here we are at question 1. Let's just dive straight in. Something I always like to point out is to read the last sentence of the question first. It's not always helpful, but very frequently it will be helpful because frequently it will give you the context for what the rest of the question is about. So imagine you see a big paragraph and you read the last part of the question first. Frequently, that will tell you what the rest of the paragraph is kind of getting at, and then you'll be able to read through that paragraph and understand what you're supposed to be looking for. So this is a very good habit to be in, especially for test day. So let's do it here. Which of the following procedures is the auditor most likely to perform to obtain evidence about these matters? Let's go up to the top. An auditor is assessing whether there are any material litigation, claims, or assessments that could affect the financial statements. So again, which of the procedures are they most likely to perform to obtain evidence about this? Let's go through the options. Option A, send a confirmation directly to the client's legal counsel requesting information about ongoing and potential litigation. Option B, inquire of the client's legal counsel during the planning phase of the audit without management involvement. Option C, ask client management to send a letter of inquiry to the entity's legal counsel requesting information about potential litigation. Or option D, review the legal expenses account and determine if the total amount is consistent with the prior year. So out of these different options, what is the auditor going to do to obtain the evidence about these litigations, these claims, these assessments? If you don't know, that's okay. We are using these questions to learn. So if you want, maybe pause the video and think about this, but otherwise, let's just go ahead and take a look at the explanation together. All right, here we are. The answer is C, ask management to send a letter of inquiry to the entity's legal counsel requesting information about potential litigation. So that's what the auditor is most likely going to do. This is one of the most important procedures that an auditor can perform to learn about litigation, claims, and assessments. So let's read about it. The auditor's primary procedure to detect the existence of litigation, claims, and assessments is to request that management, so not the auditor themselves, management send a letter of inquiry to the entity's legal counsel. This letter asks the lawyer to provide information directly to the auditor about pending or threatened litigation, unasserted claims, and other legal contingencies. The auditor does not send this request directly, like I said. Instead, it must come from the client, maintaining the lawyer-client relationship and privilege. Inquiries of management and reviewing legal expenses are also performed, but the letter of inquiry is the most direct and authoritative source of evidence. So there are a few other things that you can do to get evidence about this, and we're going to talk a little bit about those. But the best way, the primary procedure to do it is to have management send a letter of inquiry, like for the auditor, to the client's attorneys/lawyers. Now with that, let's go to the next question. All right, here we are at question 2. Which of the following additional procedures would most appropriately help the auditor detect unrecorded or undisclosed litigation? So let's go up to the top. While auditing litigation, claims, and assessments, an auditor recognizes that a legal letter alone may not identify all potential legal matters affecting the financial statements. So again, which additional procedures would they most likely do to detect unrecorded or undisclosed litigation? So these are other things. We're going to talk about other things that you can do to get the evidence for this. So let's go through the options. Option A, sending negative confirmations to customers with outstanding receivables. Option B, reviewing correspondence from regulatory and taxing authorities addressed to the client. Option C, comparing the client's current year legal expenses to the industry average. Or option D, performing inventory price testing to evaluate valuation of obsolete items. Now, reading through those, there's probably only 1 or 2 that actually kind of make sense in the context that we're reading through. And by the way, that happens a lot in audit. If you can kind of carefully read through the question and read through the different options, frequently 1 or 2 of the options will just seem totally useless or not really related. Maybe not always, but frequently that happens. So you can usually narrow it down to at least 2 options, hopefully 1 option, the correct option, if you carefully read through the options. At any rate, let's go ahead and take a look at the explanation for this question. All right, here we are. The answer is B, reviewing correspondence from regulatory and taxing authorities addressed to the client. So this is another thing that an auditor can do to get evidence about the litigations, claims, and things like that. Now let's read through this, and it will give you an idea of multiple things, not just the correct answer, but it'll give us an idea of other things too. In addition to obtaining a legal letter through management, auditors should perform other procedures to detect potential litigation, including inquiring of management and others within the entity. That makes sense. They would ask management, do you know of any litigation? Reviewing minutes of board of directors and committee meetings, reviewing correspondence from taxing authorities or regulatory bodies, which may reveal disputes or investigations. If tax authorities have some kind of litigation that's coming, they're going to send that correspondence to the client. So if the auditor finds that correspondence, that can kind of give them an idea if there's some litigation or claims that have to do with these tax authorities. And then finally, examining legal expense accounts and invoices from legal counsel. So, the option where it was comparing the current legal expenses to the industry average, that wouldn't be very helpful. But examining the legal expense accounts and invoices from legal counsel to see what the company is paying for legal expenses and why, that might give the auditor an idea as well about certain litigation that's going on. Option B is correct because such correspondence may uncover tax disputes, penalties, or regulatory actions that could give rise to litigation. The other options are unrelated to identifying legal contingencies. And again, if you read through them carefully, it's pretty obvious that most of the other ones are not really related. Now let's go to the next question. All right, here we are at question 3. What is the primary purpose of this discussion? Let's go up to the top. As part of the audit procedures related to litigation, claims, and assessments, the auditor discusses with management how the company identifies and evaluates potential legal matters. So what's the point of them talking to management about this? Let's go through this. Option A, to determine whether management has consulted legal counsel during the year. Option B, to assess whether legal fees are appropriately classified in the financial statements. Option C, to identify who at the company is responsible for authorizing legal settlements. Or option D, to evaluate the design and implementation of controls related to identifying legal contingencies. So if I'm honest, multiple of these kind of sound like they could be right. So pause this if you want to and kind of think through this, but if not, that's okay. Again, we're using these questions to learn. So let's go ahead and take a look at the explanation. All right, here we are. The answer is D, to evaluate the design and implementation of controls related to identifying legal contingencies. That would be the primary purpose of them talking to management about how they identify and evaluate potential legal matters. Let's go through the explanation. Auditors are required to understand the processes and internal controls management uses to identify, evaluate, and account for litigation claims and assessments. This includes discussing how such matters are brought to management's attention, who is involved in assessing their financial impact, and how they determine whether disclosure or accrual is necessary. Understanding these controls helps the auditor assess risk and determine the nature, timing, and extent of further audit procedures. So the other ones, maybe they could be helpful, but the primary reason that they are going to do this is to understand the controls that are behind this so that they know if it's effective and they know that management is being informed of these kinds of things in the proper amount of time and in the proper way. Now with that, let's go to the next question. All right, here we are at question 4. What is the auditor's most appropriate response? Let's go up to the top. During the audit of Clearwater Systems, the auditor requested that management send a letter of inquiry to the company's external legal counsel regarding potential litigation, claims, and assessments. Management refused, stating that they do not want to involve their attorneys. That sounds fishy. What is the auditor's most appropriate response? Let's go through the options. Option A, treat the refusal as a scope limitation and consider withdrawing from the engagement. Option B, issue a standard unmodified opinion if no litigation has been identified through other procedures. Option C, accept management's refusal and rely on their written representation letter instead. Or option D, note the refusal in the audit documentation but proceed with other substantive procedures. So what is the auditor going to do if management refuses to send a letter for the auditor to the external legal counsel? Sounds like a big red flag to me, but maybe not. Pause the video, think about this if you want, and come back when you're ready. All right, here we are at the answer. A, treat the refusal as a scope limitation and consider withdrawing from the engagement. So that is probably the answer that makes the most sense based on us reading through it. So let's read through the explanation now. If management refuses to send a letter of inquiry to legal counsel, the auditor cannot obtain sufficient appropriate audit evidence regarding potential legal liabilities. This is considered a scope limitation, and we've talked about that in a video or two where, if the auditor is being limited from getting the evidence that they need, that's not good. When such a limitation is imposed by management, and especially if it appears intentional or unjustified, the auditor should consider withdrawing from the engagement. If the auditor does not withdraw, they must evaluate whether to issue a qualified or a disclaimer of opinion depending on the materiality and pervasiveness of the issue. Simply relying on a representation letter or other procedures is not sufficient in this situation because, again, remember the primary way that auditors are going to learn about litigation, claims, and assessments for legal matters is going to be that letter to the legal counsel of the client. So if the client is refusing to send the letter for the auditor, that's not good. They should probably withdraw from the engagement, or if they don't, then they're probably going to have to issue a qualified or a disclaimer of opinion. Now with that, let's go to the next question. All right, here we are at question 5. What is the auditor's most appropriate next step? Let's go up to the top. While performing audit procedures, the auditor learns that a lawsuit was filed against the client 2 weeks before year end. Management had not previously disclosed the matter, so what is the most appropriate next step? Let's go through this. Option A, assume the lawsuit is not material and continue audit procedures as planned. That sounds kind of silly. Option B, ask the client to determine the probability of an unfavorable outcome and evaluate whether an accrual or disclosure is necessary. Option C, immediately contact the client's legal counsel directly to obtain facts about the case. Or option D, require management to accrue a loss equal to the full amount of damages claimed in the lawsuit. All right, so what is the auditor going to do if they find out that the client suddenly has a lawsuit that they haven't really talked about? Now, based on everything we've learned, you could maybe kind of logic your way through this, kind of think through this. So pause the video, think about this, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is B, ask the client to determine the probability of an unfavorable outcome and evaluate whether an accrual or disclosure is necessary. So let's go through the explanation. When the auditor becomes aware of a newly filed lawsuit, they should ask management to assess the likelihood of an unfavorable outcome, such as, is it probable, is it reasonably possible, or is it remote? And I think we talked about that a little bit in a previous video. I can't remember if that's the case or not. And estimate the potential financial effect. Based on this assessment and applicable accounting standards, the auditor evaluates whether a loss contingency should be accrued, disclosed, or neither. The auditor may then corroborate this assessment by requesting a legal letter or reviewing legal correspondence. The auditor should not make legal or accounting determinations for the client, so that rules out options C and D, and they cannot dismiss the matter without proper evaluation. You usually can't do that at all in an audit, so that rules out option A as well. So again, that's what the auditor is going to do if they find out about a lawsuit or about litigation that they didn't know about before. They're first going to talk to the client about it and ask, hey, do you think this is probable? Do you think this is something that's totally remote? It's probably not going to happen at all. They kind of want to get that feel for it first before they do anything else. And with that, we've learned a lot about how an auditor is going to detect litigation, claims, and assessments for legal matters in these questions. Before we do anything else, let's do one more part of the SuperFast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions to learn the material, you will notice the things that keep popping up in the questions. You've seen 2 or 3 or 4 questions trying to teach you about the best approach being to reach out to the legal counsel of the client, but that it has to be through the client. You know, those are the kinds of things that you see popping up in the questions or whatever the case is. And you write them down in your own words as the pillar topics, or again, the most important things you learned from the questions because you saw it multiple times. And as you're doing this each day, you're building your own personal repository of the most important things you learned from the questions you did, and you're writing it in your own words so that you are ready for the exam when it comes. Let's go ahead and take a look at the pillar topics for this video. Okay, here we are at the pillar topics. Let's just dive straight in. First off, let's talk about legal letters and that they must come from management. Auditors do not contact a client's legal counsel directly. Instead, they request that management send a letter of inquiry to obtain evidence about litigation claims and assessments. Next, let's talk about what if the client has a refusal to send, and that being a scope limitation. If management refuses to send a legal inquiry to legal counsel, it creates a scope limitation. The auditor should consider withdrawing or issuing a qualified or disclaimer of opinion. Now let's talk about the next one, understanding management's legal controls. This is something that the auditor needs to do. Auditors must understand and evaluate how management identifies legal matters, including the controls and processes used to track and assess litigation claims and assessments. Now let's talk about management's assessment of legal outcomes. When a legal matter is identified, management must assess the likelihood of an unfavorable outcome and estimate the potential loss. The auditor evaluates whether the accounting treatment is appropriate. So the management is the one who's going to think about the likelihood of it, and the auditor is going to kind of assess if they think they did it with the correct accounting treatment. And then finally, using multiple procedures to identify legal matters. You know, we talked about how you can send a request to legal counsel directly. That's probably the best one, but there are other ways that auditors can detect evidence of these things. Auditors detect legal exposures through inquiries, board minutes, legal expenses, and regulatory correspondence, not just legal letters. So there are a few different ways that auditors can gain evidence about the existence of litigation, claims, and assessments. And with that, we've learned a lot in the first 5 questions and these pillar topics. And remember, in this video, we're only going over 5 questions, but the SuperFast CPA Pro members are going to get access to the full 10-question version of the video that I'm about to finish recording after I finish this. So make sure you check out Becoming a Pro member so you can get access to the full versions to get a little bit more help and a little bit more understanding. And the best way to do that is actually by going to SuperfastCPA.com and signing up for our free 1-hour webinar training. Again, it's free, it is 1 hour long, and we will teach you the key ingredients to passing the CPA exam. And after you watch that, that will give you a great path to, again, learning more about SuperFast CPA and learning about becoming a SuperFast CPA Pro member. So check out the webinar, check out Becoming a Pro member. If you liked the video, make sure to like it and leave a comment. I hope this video was helpful, and I will see you in the next one.